Welcome to the deep dive. Today we're setting our GPS for the high seas. We're looking at the recent sort of choppy but also rewarding financial waters of the cruise industry.
Mm-hmm.
And our focus is squarely on the heavyweight Carnival Corporation, ticker CCL, as they get ready for a really high-stakes earnings report.
That's right. You've handed us a stack of fresh
Yeah.
reports, current financials, market analysis, and it covers Carnival, Royal Caribbean, and Norwegian,
The big three.
the big three. So our mission for you is to figure out if Carnival can actually stick the landing on its upcoming Q4 results.
Right.
Can they grab the market narrative, lead this rally we're seeing, or are they just going to keep, being the biggest ship in the harbor that's always trailing the others?
Okay, let's unpack that because it's such an unusual situation. I mean, if you just read the headlines, you'd think the whole sector was enjoying really smooth sailing.
For sure.
Carnival stock, for example, it's been pretty robust lately, climbed a solid 10% over the past month.
Which feels great in a vacuum. If you were watching it struggle earlier this year, that 10% looks like a party on the pool deck.
It absolutely does, but that feeling it dissolves the second you add context. And I think that's the first critical piece for our listener here. The performance gap.
Yes, the sources are so clear on this. Comparison in this market really is the thief of joy.
The numbers totally confirm that. So
Okay.
Carnival's up 10%, great. But then you look at Royal Caribbean, which is the largest player by market cap right now.
Mhm.
They're up a much more robust 13% over that exact same period.
And then there's Norwegian Cruise Line.
Yeah.
I mean, historically, they're the laggard of the group, right? They've struggled the most with post-COVID debt.
Yeah, with execution.
Exactly. And they managed to jump an even heftier 18% in the past month.
Wow.
So what you're seeing is all three stocks catching this strong tailwind, but Carnival is, it's definitively being outpaced by both its rivals.
So the central tension isn't really about Carnival failing. It's more about its inability to keep up with the pace. They are recovering, but just slower.
It's just slower. But they have a shot right now to change that narrative.
And the timing is critical.
Couldn't be more critical.
Yeah.
Carnival reports its fiscal fourth quarter results this Friday morning. And that report is following what one source called a disappointing third quarter update that triggered a sell-off.
Even though they beat their own income estimates, which is the crazy part.
Which is the crazy part. So this report, this Friday, it's their shot at redemption. They have to show acceleration, not just, maintenance.
Let's get into those expectations then. What is Wall Street actually modeling for this quarter that just ended in November? This is the moment for them to prove they're picking up speed.
Okay, so we have to look at two things. The top line, so revenue, which tells you about demand and pricing power,
Right.
and the bottom line, profitability, which tells you about efficiency. On the top line, analysts are modeling about $6.38 billion in revenue.
6.38 billion. I mean, that's a huge number for just 3 months of business. What kind of growth is that year over year?
It represents a 7% year-over-year increase, and that 7% figure. It's arguably the most important number in this entire report.
Wait, why so much focus on just 7%?
Because if you rewind just 3 months to their Q3 report, Carnival only managed a 3% year-over-year revenue increase.
Okay, got it.
That was the source of all the investor anxiety. So jumping from 3% to 7% growth in a single quarter, that's the kind of rapid acceleration investors are dying to see.
And if they hit that number?
If they hit that $6.38 billion, it also lets Carnival stretch its streak of record results for a particular quarter to 11 periods.
Which is just incredible operational resilience.
Okay, so the revenue has to accelerate
Mm,
dramatically. But the story gets even stronger when we look at profitability, the bottom line.
it does. Analysts are targeting a profit of $0.25 per share. That's the adjusted EPS.
And it's important to note that adjusted figure, right? Especially in this industry. It is. I mean, these companies took on so much debt that adjustments often strip out big non-recurring costs. Debt restructuring, interest payments,
Yeah.
just to give you a clearer picture of the core business.
So assuming they hit that target, how big of a jump is that profitability-wise?
Oh, it's massive. That quarter-over-quarter growth is huge.
Yeah.
The $1.25 per share is nearly 80% above the $1.14 per share they posted a year earlier.
80%.
But what's really fascinating here, and what gives Carnival a kind of built-in advantage, is their history of beating these specific profit expectations.
I saw this in the source material, and it almost feels contradictory to the stock lagging so much. They actually have a history of overperforming on income.
Absolutely.
Yeah.
Since they got back to full operations post-COVID, Carnival has consistently topped the market's quarterly income expectations. for more than 2 years straight.
Every single quarter.
Every single quarter. We're talking about massive historical surprises, sometimes over 400%, even 600% above what the street was guessing on profit. They know how to manage expectations and deliver on the bottom line.
So you have this weird dynamic. On one hand, an amazing track record of beating profit estimates. On the other, the market is deeply skeptical because of that revenue lag in Q3. Let's dive a little deeper into why that 3% was such a problem.
That 3% was a problem because, it barely kept pace with inflation over that same period. Think of it this way. If your ticket prices and your sales only go up by 3%, but the cost of everything you buy, fuel, food, labor, also went up by 3%.
Then you've achieved zero real growth.
Exactly, zero. And for a company trying to convince investors it's back on a growth trajectory, zero real growth is a huge red flag.
That makes the skepticism totally understandable. It's not about the paper profit, it's about a lack of pricing power.
Precisely.
Yeah.
And the competitive lag just re-emphasizes that fear. That 3% was in Q3, the summer quarter, when demand should be at its peak.
Right.
While Carnival was at 3%, Royal Caribbean and Norwegian were managing a modest but better 5% top-line growth. Carnival was running squarely in the back of the pack during peak season.
And the scary part is, that gap is only expected to get wider, which is why this week's report needs to be, like you said, a knockout punch.
That's the critical piece. Investors aren't just looking at the past, they're looking ahead. And when you look at the expectations for Royal Caribbean and Norwegian in their next quarterly updates,
The first half of the year?
yeah, the market is banking on even more explosive revenue acceleration from them. We're talking gains of 14% for Royal Caribbean and 11% for Norwegian.
Wow. So if Carnival delivers 7% this week, but its rivals are expected to deliver 11% and 13%, that gap means Carnival is just getting left behind in the perception battle.
It does. It suggests Royal Caribbean is doing something fundamentally better, whether that's fleet management, routing, premium pricing, something.
If you're an investor looking for pure growth, you're putting your money on the other two right now.
And you are.
Yeah.
But we have to circle back to the defense for Carnival. Because despite that slow 3% growth in Q3, they did exceed expectations. And crucially, they once again raised their own guidance across all publicly forecasted metrics.
That rising guidance is the silver lining, right? It signals that internally they're confident.
It is. You can track their fiscal 2025 profit guidance like a barometer.
Yeah.
They started with expectations around, $1.70 per share? That has gracefully risen to $1.83, then $1.97, and now it stands confidently at $2.14. They keep setting the bar higher for themselves and then clearing it.
So they're meeting their own targets, just not the market's demand for competitive growth.
That's the perfect way to put it.
Okay, so let's bring this back to valuation. If Carnival hits that new raised guidance of $2.14 share, by the end of this week, we're looking at a stock trading for about 13 times its trailing earnings.
Right.
On the surface, that sounds cheap.
It does, but let's translate what that means for our listener. A 13x PE ratio means you're willing to pay $13 for every $1 the company earned over the past year. Generally, the lower, the cheaper.
So 13x sounds like a bargain compared to the S&P 500, which might be closer to 20x or more.
It is, but you have to look inside the sector. Norwegian is actually trading at an even lower, far cheaper multiple.
Ah.
So if Carnival is at 13x and Norwegian is at, say, 10x, the market is telling us something complex. It's saying Carnival's cheap, but maybe Norwegian is either a deep value play or it's just too risky and heavily discounted. Valuation alone isn't giving Carnival that premium status it wants.
And we know beating profit expectations wasn't enough last time because the revenue growth was so slow. So what specifically does Carnival need to show the market this Friday to start closing that gap and get the kind of premium multiple Royal Caribbean has?
They need visibility, confirmation of future pricing power, not just current efficiency. So first, they must show very strong booking trends.
Looking out to 2026.
Exactly. Investors need proof that people are booking cruises far into the future and at good prices. That future revenue pipeline needs to look full and robust.
Right, locking in future revenue. Okay, what about that industry metric we always see, net yield?
Net yield is crucial. To translate that technical term adjusted gross margin per available passenger cruise day, just think of it as the real measure of pricing power. It strips out volatile stuff like fuel costs. So what's left is a very pure picture of how much revenue they're generating per passenger per day, adjusted for their capacity.
So it's not just about filling ships, it's about how much money they're making from each person on that ship.
Precisely. Carnival's net yield will need to exceed its already record results. That proves they're not just filling ships, They're raising prices and expanding margins.
And then the potential game changer.
The dividend question.
The dividend. This is the signal the market is waiting for. Royal Caribbean is the market darling, and a big reason is that they reinstated their quarterly dividend.
It's a sign of confidence.
It's the ultimate sign of financial stability and confidence. During the shutdown, Carnival took on a mountain of debt just to survive. Reinstating a dividend is a statement from management that says, our cash flow is so reliable we can pay down debt and return capital to shareholders.
But there's a tension there, right? You're signaling health, but maybe at the expense of fiscal prudence? Wouldn't investors rather they just focus on the debt? It's a calculation of trust versus cash flow. If Carnival were to follow Royal Caribbean's lead, it would be a huge step in commanding that premium valuation because it totally changes the perception of long-term risk.
So, to synthesize all this, beating income expectations is now just the baseline. It's table stakes.
Exactly.
If Carnival wants to keep this stock rally going and genuinely shift investor perception, they need to show the market something it hasn't seen before.
Absolutely. They've proven they can be efficient. Now they have to prove they can be a dominant competitor, either through a decisive leap in revenue growth or by taking that financial leap of faith and reinstating the dividend.
That's the combination that elevates them from just a recovery story to a market leader.
You got it.
This has been a really comprehensive deep dive. I think the core tension is perfectly clear for you, the listener. Carnival is undeniably improving. It's consistently raising and beating its own guidance, but it risks being perpetually overshadowed by the faster growth and premium valuation commanded by its chief rivals.
It leaves us with one provocative thought for you to consider as you watch this all unfold on Friday. Given Carnival's history of raising and then overshooting its own guidance, we know they're profitable. So what specific action, beyond just more profitability, would truly be that something it hasn't seen before?
Right.
Is the dividend the indispensable signal of maturity and trust? Or would a quarterly report showing Carnival's revenue growth decisively leapfrogging Royal Caribbean's projections be the true proof that they're finally ready to lead this sector?
That is the question that will determine whether Carnival truly takes control of its own narrative this Friday. Keep analyzing the market, and we'll catch you on the next deep dive.